Hey everyone, we're going to go ahead and start. There aren't that many people in here, so maybe a few of you don't know, but for the past week we've had the trading room open for anyone that wants to come in and watch and see how we trade. And we're also having a sale on the software until Sunday night. What we're doing today right now, however, is not geared towards a sales presentation or anything like that. It's for kind of recapping all of the methods that we use for all of the people that have been in the room for the past week, and mainly for the members to be able to refer back to this video as kind of a training video. So we're just going to kind of take it easy, very informal, and cover some of the different methods that we use and make sure that everyone understands exactly why we took the trade that we took today and how we set up for that, and then how we kind of fine-tune everything on the faster charts. So yeah, I am recording, and the recording will be available later on this evening, and I'll put that in the members area and also on the sales page, which is here. And then we'll have the final webinar on Sunday, which will be more geared towards a sales presentation, more formal, with a bit of a PowerPoint and stuff like that. So right now we're just going to cover putting everything together and the trade that we took today in the room. And again, that link where the recording will be on this page if you're a member. Then it will be in the members area, and yeah, all the other recordings will be available as well, and you'll be able to watch those tomorrow and Sunday. So if you're not in the HIP chat and you want to ask questions, let me get that link in here. For some reason it's not, I don't have the link when I'm not signed in on the web page. So we've, like I said, we had the trading room open all week this week, and we've let anyone come in that wants to, and we have a chat room that's open 24 hours a day, 7 days a week, and that's the link to the chat room. You can join right now and ask questions there in the chat room. If you're interested in asking anyone else, their take on the software, how everything's worked out for them, their opinion of everything, feel free to do that. And there are plenty of people in the room that would be willing to answer any questions that you have. And I'll start taking some questions here in a minute as we start to get into the different methods and how we put everything together. So typically in the morning, well, not typically, every single day, we start off, I say every single day, almost every single day, until I make mistakes. We start off with a pre-market routine, okay? And we base most of our trading decisions on the higher time frame charts. So for each market, we're looking at about 6 or 8 different time frames. I guess 8, really. But the higher time frames we mainly just look at once or twice a day. So we'll start off with a daily, and typically we only need to look at that 2 or 3 times a week, and then kind of home in on the 240 minute and then the 60 minute. So what I want to do is I want to go over why we took the trade that we took today in the room, the areas that we were trading from, and how we bring all of these methods together to fine-tune our entries and our exits. And you'll see exactly how that plays out in a live situation as we had today. And the video from today will be up this evening as well, and I'll send out a link to that so you can watch how this unfolded in real time. So let's start off. Let's see here. Let's start off with the 240 minute and the hourly. And if you are brand new, the software that we use is the main thing that we use for the market geometry, which is, I think, really the backbone to the system, because those are the areas that we're trading from, are the market geometry areas. And then I would say the next most important thing would be the relative volume, which we use to confirm those areas, to confirm that the volume is actually coming in. We have a lot of supply coming in at a high or demand coming in at a low. And then we also use the divergence and either momentum or stochastics or both to kind of help confirm the areas, and then volume on the tick charts as well, and something called volume per second. So I'll get into all of that in a moment. And typically, if I'm looking for a trade at a much higher time frame, such as the hourly or the 240 minute, I'll wait for something called volume divergence on the faster charts, like on the 3 minute or the 1 minute or the 233 tick in crude oil. So the fastest chart that we look at is just a little bit faster than a 1 minute, and typically I make the tick chart. I have 2 tick charts, and the faster one we try to make just a little bit faster than a 1 minute chart. Okay, so right now that would be a 233 tick in crude. If things start to slow down, then we may have to go down to a 144. If they get faster, then we may go up to a 377 or something like that. So we start by creating the areas in the market geometry. And at this high, we had a few different areas coming together. So here we had a trend line, a downtrend line coming in right here, which was the high yesterday, the exact high yesterday. And then it came together with the median line and the channel line. Okay, and you see how it draws those automatically. Here it's splitting the channel line, and then the new channel line is redrawn as it updates. And each of these lines has alerts built into them. Here you can see the original channel line, which was drawn from that low right here. Let me take this off. Okay, that was split right here. Alright, and then it draws a shadow line, what we call a shadow line. If I were to draw a standard trend channel, it would just keep that line going all the way, right? So when it broke back inside of that channel, it used the original midpoint as resistance right here, and then it used the channel line as support right here. Okay, so we know that that line is an important line, and we know that this downtrend line is obviously the very correct one, because the midline is being respected and the channel line is being respected. So when it comes up and it tags that downtrend line right where the median line intersects it, we know that that's going to be a strong area. The problem that I had on Thursday, and it's just, regrettable, but I've had a pretty intense week and not getting much sleep, and I jumped into a short right here, which was actually from this, I think it was a median line right here. What was it? No, it wasn't from that area. It was from right here. So I jumped into a short before doing the pre-market routine, so I wasn't following my own rules, and I got into that short right here and ended up, with a pretty large position, thinking that this was about to roll over, but ended up getting stopped out. So pretty much the whole entire week I had been very conservative, only trading a few contracts, whereas I allow myself to trade one contract per 10,000, so up to 18 contracts. And then here, for some reason, I guess sleep deprivation and whatever, just coming to the computer, seeing something line up and immediately jumping in, which was an old habit that took quite a while to break. That whole jumping in when you're not ready, when you haven't done all of the work that's necessary to allow yourself to take a trade. That kind of came back and bit me in the butt, and then I got stopped out. And then we saw this come together, and I said, well, that's the perfect entry. And we talked about it, but I didn't take it, unfortunately. And then it came crashing down, about 200 ticks within a couple of hours. So we saw this happening in real time, but I didn't take advantage of it. A couple of people in the room did. But then after this, we had a correction start. Okay, so we had, out of this high, which came together beautifully, we had an impulsive move down, and it came straight down, right? So this is your typical ABC pattern, corrective wave and Elliott wave. All right, we do use the wave principle guidelines. We don't teach it strictly like they would at LAwave.com. We just kind of use it to build a kind of a framework or a roadmap for setups throughout the day. And sometimes waiting for that fifth wave, even on an intraday basis, even when it's just a wave out in the middle of nowhere, you have no idea exactly the true wave count, but sometimes waiting for that fifth wave will help keep you from getting into a trade way too early. And so that's kind of the way we use the wave principle, just kind of basic guidelines. We don't really stick to the precise rules and use it so rigidly like some people would teach it. So anyhow, at this high, everything was coming together perfectly. And we had a ton of volume coming in. And when you see two areas within the market geometry coming together perfectly like that, using different swing points, that's typically a very, very high probability entry at that area. And being that it's on the 240 minute, you know that it's going to be a pretty major reaction. Okay, so we see that reaction Thursday, and then today and overnight we have another A, B, C correction. All right, and it comes back up and nearly tags that downtrend line once again. So when we look at it on the 60-minute chart, and we're seeing all of this in real time and talking about this in the pre-market routine, we see this and we say, okay, it obviously had an impulsive move down, and it's just been kind of going sideways with overlapping waves since the afternoon and the overnight. Okay, so I'm telling everybody in the room this: if it comes up and it breaks this high, then we'll be looking for a potential end of an ABC correction, which would be A, B, C. And if you're not familiar with Elliott wave, don't worry about it. You can learn it for free on a lot of different websites, but it's just kind of a market. It's basically pattern recognition. So you're looking for 5s and 3s. You're looking for impulsive moves in sets of 5 waves with trend, and then corrections usually in 3 waves or triangles or something of that nature. So corrective patterns tend to be overlapping, kind of range-bound waves that correct a previous very strong move. Okay, and in this case, I think we retraced about 78.6% of this move. Whoops. 78.6 exactly. And crude oil, for some reason, seems to like that 78.6 for a second wave a little bit more often than it would the 61.8. So we do use fibs, we use confluence zones, but again, that's more of a kind of confirmation type of thing. The most important thing is the market geometry, the trend channels, the median lines, and then the relative volume confirming those areas. Then we have these other methods that help confirm the areas and then build our confidence in the probability of that trade working out. Okay, so we have a lot of different things that come together, and it's kind of like building confluence. The more we have in favor of the trade, the higher we would rank that trade and its probability of working out. And then we would define our exits and our targets based on the wave structure and based on the size of the channels. And then we know whether we need to be holding this thing for a very large move like we did today, or whether we need to be getting out, fairly quickly, especially if we're trading an area, say, only on the 5-minute chart. All right, so what we're doing here is pretty complex, and if you've been used to, red light, green light stuff, go long when you get the little arrow, piggybacking someone else's trades and not really learning much about why the market moves the way that it does, and you've been stuck on technical indicators, oscillators. Yes, we do use oscillators, but for very specific purposes, mainly for momentum analysis, and like I said before, just kind of as a confirmation type of thing. So if you've been stuck on red light, green light stuff, and maybe automated systems, things of that nature, and you haven't really learned some of these more complex methods, such as volume analysis, which can be very convoluted, especially if you're not learning from the right person. Market geometry, which many people don't even talk about, and I don't understand why. It's the most beneficial thing that I've ever found in trading. And I know a lot of big traders would agree with me that have tons and tons of money. That's one of the first things that I learned actually working at a fund was market geometry and volume, and that seems to be the two most things that are kind of neglected by the typical ninja trader community of vendors. So most people would focus on creating some sort of mathematical equation, some new fancy oscillator. There's no such thing as a fancy oscillator, guys. There are no secret oscillators. Form-fitting mathematical equations to the market has really never done anyone any good. So if you want to learn how to really make money trading, then you have to learn some good methods that actually affect the market, how the market works and moves, and you have to learn what makes the market move the way that it does, why these reversals occur, where they occur, and what a typical reversal pattern would look like across multiple time frames. And if you're not willing to take the time and the effort to learn these different methods, then it's going to be quite difficult for you to succeed as a trader. I'm sure most of you know by now, especially if you've been in this business for any number of years, it takes quite a long time to reach profitability. It took me 7 years, 7.5 years, to get to the point where I was actually being consistently profitable, and it was a long and difficult road. I'm sure a lot of you have been down the same road. So using these methods that we teach you here, I guarantee you that if you learn them and you apply them, you can easily make money with it. Many people in the room saw that this week. So, and anyone in the room could confirm that for you. So what we were looking at here was a potential move down out of this high, but we were waiting for a little bit more specific look to it. So I was waiting for, I'll show you what I was looking at. I was essentially waiting for a volume divergence signal. I can't show it on this chart because we got a huge wick on it. This is the 60-minute. So we'll go down to the 20-minute here in a moment. Let's see. Let me see. Yeah, okay, that's it. Alright, so we also had a trend line from here that was acting as resistance as well. So I was waiting for that to be hit, and basically what we were waiting for was this high to be taken out right here, and then a move back up just a little bit higher through this. That's kind of hard to see. Let's just move directly to the 20-minute right now, and then a move back to the top of the channel. So the market moves in channels. It just does. I don't know, why it does that, but people have been using trend channels and trend lines since the late 1800s. So Robert's asking, why do I discount long wicks? I don't discount long wicks necessarily, but typically if there's a really huge wick, the market didn't trade up there for very long. Okay, so if there's a really huge wick, oftentimes we'll use the high, if it's at a high, the next high at either the previous bar or the next bar, and you can kind of go back and confirm that the market does, or at least the guys that are using this market geometry, rather than using the huge wick, will oftentimes use the previous bar's high or the next bar's high. And you can go back and kind of prove that out to yourself. And we'll spend some time. We're going to do these training sessions at least 2 days a week, probably 2 or 3 days a week. Okay, so here we are. This was the high right here that we traded. And this is a 20-minute chart. So we're looking at the open right here. Yeah. So that's the opening bar right there. All right, so at the open, we're doing our pre-market routine, and we're looking at this and we're saying, okay, we've made one wave up, a wave back down, and we're starting another move up. We were looking at this median line. I was saying, okay, well, we're at an area. This could be potentially the area where it turns down from, okay? But I'm not going to take it because the market is in a very strong position. It's just opened. Let's kind of see what it's going to do. What would make more sense, since we've had this big move down, what would make more sense is if this were an ABC pattern and we go up and hit this auto line right here, the channel line, and we take out this high. So that's what we were talking about, as this is opening up. And what's beautiful is we get the buying climax on the very next bar. Okay, so we get the buying climax. Let's look at the volume profile. I don't even remember if we had an area there or not. But here we've got a volume profile tool built into the toolbar, which allows us to add a profile to any chart without having to load all the tick data for the entire length of the chart. So it's the most efficient way to draw a profile. And no, we really didn't have much of an area there. But if we look at just these 2 bars here, 3 bars, let's just see something. We had a little bit of a high volume node right there, but that's not something we were looking at in real time, so let's just drop that. All right, so we had a buying climax here. Stochastics are obviously very overbought on the 20-minute and kind of going sideways. So we know that a high is probably coming in pretty soon. All right, but we want to fine tune this thing. You know, on a 20-minute chart, if you're trading just the 20-minute chart, your stop is, you know, likely to be over 30 ticks, especially right now in crude, even more possibly. All right, so we want to fine tune this, and then we go down to the 5-minute, and I've got this really cool little tool here built into the toolbar that when I click on it, click on a chart, and then click on a new chart, it allows me to scroll simultaneously. This is perfect for back testing by hand. I don't know why Ninja never included this in their platform. A lot of other platforms do include this, but it allows you to synchronize scroll your charts, and then if you click on it again, you can click on a high or a low or whatever, and then bring that out into the middle. And just a really, really useful tool. It's like the favorite thing that I've added to this. Al is saying, thanks for that, but there's still subjectivity involved, similar to Elliott wave counts. Yeah, of course there's subjectivity involved in trading. This is discretionary trading. So if you know of any fully automated system that makes money, I'd sure like to know about it. But this type of trading that we're doing here is the most profitable thing that I've ever seen. Al. And just to show you, again, running my tests here, running the track record since March 1st, I've been able to take a $10,000 account to 180 in about 10 months with a 5.2 profit factor. That's not 1,000 trades, it's really 490 trades. 62% profitable with a 3.2 win-loss ratio. So he's talking about where to draw the trend lines. Yeah, it's not. There is some subjectivity involved in determining which points you draw the lines from. But the more you do it, Al, and you know this goes for everybody. The more you do it, this is what I say the most to everybody. If you'll just draw all the time on your charts, anytime you get some spare time, mark up your charts, draw as many trend channels, as many trend lines, and median lines as you can. Go back historically on all of your different charts and just see where the major swings occurred that day, and see if there are any areas where you would draw your trend lines from and your channels, and just see if they line up with any of the swings. And the more you do that, the more you'll see how important this stuff really is, and you'll get better and better at choosing the right points. All right, the right swing highs and lows. But typically it's, you know, the major swing highs and lows. You're not gonna just draw from this bar. You know, you're not gonna draw from that bar to this bar or something stupid like that. So it'll become more and more obvious to you the more that you do it. And now I would just recommend, you know, going through as many charts as you can and just drawing as often and as much as you possibly can. I would spend, you know, at least a week or two just doing that all day, every day. And then, Al, if you want, you know, you can send me, any of you guys, you can send me your charts. You can post them in the room, and we'll discuss them. That's really what the room is for you guys to learn. And ask me any questions that you want. If you have, you know, you've built some charts out and you're not sure about something, then you can ask, and I'll be willing to go over anything you guys want me to. So you see this, for example. If you were drawing this not automatically, see, this is semi-automated. All right, so I'm drawing from this high to this high. Now, I didn't mean to be rude. I thought you were kind of criticizing discretionary trading or something. I didn't pick up on what you were referring to. But anyhow, this is automatically finding this swing low right here. All right, so if you were drawing, this is the widest point perpendicular to the channel. It's actually just slightly wider, maybe by, you know, a quarter of a tick, than that swing low. But if you were drawing this by hand, and you were drawing a median line in, you would likely pick this swing high, and either that swing low or this swing low to draw your median line. And then when you do that, you're like, this stuff doesn't work. It's gone right through it and blah, blah, blah. But see, we've automated the choosing of that that third swing point. So at least that part of it is automated. So it's your job to choose the two swing points, and that'll get more and more obvious to you the more that you draw this stuff. So we choose these two swing highs, and then look at how it comes together. This is typically what we look for. This is what we would love to see every single trade, but it's something that occurs, I don't want to say rarely, but it's less, you're less likely to see this as often as simply just a move to either the median line or the trend channel line. Okay, but you see right where they come together, and this is what helps you time the end of a move. Oftentimes where that median line intersects the channel line is the exact spot in time and price where the market is going to make that final swing low or swing high. Okay, so that's the kind of perfect look to what we're looking for. And the fact is, at that low, we have the volume confirming it because we have what's called a churn bar there. And the churn bar means very high volume per range. Okay, which is telling us that if there's very high volume per range, then there's obviously a lot of, at a low, a lot of demand coming in, at a high, a lot of supply coming into the market there. And that's what the relative volume allows us to confirm. And we did a class on that yesterday afternoon, which I'll put up on the website tonight. And you can go back and learn about the relative volume and why it's so important. So I was asking, why would you not choose the high with the extreme for this second high to draw from? Why would I not choose this high, Al, right here? Because that high occurred after the swing low. You know what I mean? So we're looking for this swing low. So that swing high hasn't occurred yet. We're right here. The market has just started its new descent. You see? So I'm drawing from the swing high to the swing high, and then looking for the potential for the end of this move in time and price. So if I'm short from this high, this is at 820, so this is the opening bar. Look, this is perfect. Couldn't ask for a better example. From low to low, you see this? We're overthrowing this auto line, this channel line right here. Let me do it from the first swing low there. We're overthrowing the median line and the auto line, which is kind of typical of a correction. You just get a little bit of an overthrow. And then we reverse down. So we've got the perfect little A, B, C, right? And it's right to S1 of the weekly pivots. So we've got a perfect little correction of this big move down, and then it started the new descent. So we want to see, well, it's going down now, so after a correction, it's, you know, very likely, if it is a correction, then it's 100% likely to break that swing low. So after it breaks that swing low, how far will it go? Yeah, pitchfork is a median line. The median line is the one in the middle. and then this would be the upper median line and the lower median line. Okay, you know, what's his name? Alan Andrews would call them, I don't know, something stupid. I don't like the way that he named them, but I just call it upper median line and lower median line. Okay, so we're looking for, well, the reaction lines are the Babson lines. That's a different concept. Right, Bobby? He kind of built these from the reaction line theory from Babson. He designed this from that. So we're looking for the next area where this market is likely to get down to, the next major swing low. So if we're short here, we're looking to hold for a break below this low. But then how would we have any idea of knowing how far this is likely going to go? Well, based on the market geometry. And the market geometry is telling us that time and price are coming together right here where the median line meets the auto line. And the market comes right down there, tags it. It's also at support number 2. And then the volume confirms that indeed demand is stepping in right here. And that's likely the end of the move. And then it turns back up. You see? So now that we have new swing points, we could then draw a new set of market geometry and find that swing high. So as it turns up, it breaks through the auto line. You had a little bit of volume. See, it's a weak churn bar in this case. Coming back, tagging that previous low right here. You've got some people selling that, and it does turn down a little bit. Whoops. Does turn down a little bit, but then it breaks right through it, and it goes up and it tags this previous high right here. I'm sorry, it doesn't quite get there, but it does so on incredibly high relative volume, which is after the close. So after the close, that would look like very, very low volume in the true volume, but because this is relative volume, it's looking at the normal average volume for that time period. Okay, it's looking at the volume for that time period relative to the average volume for that time period. And you can see it's 500% greater than average. So that's confirming that this upper median line is the area where the reversal is going to occur from. You can see the selling pressure come in because it's closing down near the low of the bar, and then it's rolling over. Where does it turn back up? Well, it's just respected this upper median line. So if it's respected that upper median line, what's it going to respect next, Bobby? 80% likely to do the median line, the actual median line. Right, Bobs? So that's what we do all day, every day. And you see this stuff work out literally all day, every day. And that's the only reason why I would elect to actually trade in front of people. All right, I don't think anybody in their right mind would do that unless they knew for sure that they could actually make money trading. All right, so I would be one of the few people in the entire industry that's actually trading in front of you. And I'm not doing that with a live account. That would be illegal. I'm not a CTA. But I am trading a real... I'm taking real trades in front of people. Real fake ones. Taking real fake trades, man. So, anyhow, back to this setup that we had today. So we're coming together at this high, which is right here. All right, and we're seeing that occur right here on this bar. But what I'm telling everyone is, okay, we're at the area. You can see we're at the area right now. We've overthrown the channel and we've taken out this high. So we've got a perfect looking ABC. All right, we've got some overlap here. I don't even want to try to count that. That would be ridiculous. But this last move is way too, the momentum is way too high. Okay? So what I'm telling everyone is, yes, we've got a little churn bar, that green bar right there, that's telling us that supply is indeed coming into the market right there. I'm saying we're not going to sell it just yet. What I need to see is I need to see a retracement, and then I want to see it come back up, take out this high, run those stops, and then preferably see a volume divergence signal on, say, the 1 minute or the 3 minute. Okay, and then a few minutes later, it does exactly that. It pulls back. You see, I want to see it after such a strong momentum move like that into an area on the 240-minute chart, the hourly chart, and then on the 20-minute chart, and overthrowing the area on the 20-minute chart. Overthrowing means that the momentum is so strong that it's actually going through the area. I want to see the market get weak before I'll enter it. All right, so I want to see some weakness at a high or some strength at a low. But here, weakness at a high, and then I want to go up and I want to take those stops out and make the final little push higher on a little bit lower momentum and preferably lower volume. Okay, and then we get that, we break the high, and we've got an even stronger churn bar now, so higher volume per range. And then when we go down to the 1508 tick and the 3 minute, let's do that. Let me sync all of these charts up here. Hang on 1 second. Yeah, no more Skype. Okay, I'm going to sync all of these charts now. There we go. Now then. Okay, so we have the 1508 tick, which is simply 4 times larger than the 233 tick. And then we have the 3 minute on the right. Now this indicator with the bands that you see, that's called the volume weighted average price. That's something derived from volume profile, and the VWAP was something that a lot of institutional traders were graded by. So the volume weighted average price was, or is, it's the running summation average. It's a running average of all the contracts traded at every price. So it's like kind of the average price for the day. And institutional traders used to be graded on, you know, when they've got 40 or 50,000 shares to buy or sell in, you know, some commodity or stock or some other investment vehicle, they would be graded on their average price for the day. And if the closer their average price for the day is to the volume weighted average price, the better their grade for the day, basically. All that's kind of automated now, but that's kind of the way it used to work, because you can't, you know, you obviously can't put in 40,000 shares of a stock all at the same time. Otherwise, you just, you know, move that stock 10 or 20%. So you've got to kind of ease into these positions. And that's how they would be graded, was on this curve. So what we have is the volume weighted average price, that center line, and then we have the standard deviations above it or below it. And the kind of light area is the first standard deviation. So this would be kind of the running quote unquote value area, kind of the average price for the day. So if you're trading longs, you would typically like to take a long from within that value area. If you're trading short, you would like to take a short from within that value area. You wouldn't want to be trying to go long right here because you're outside of the value, right? You could attempt an along there for a day trade or along here for a day trade, but you wouldn't take a short right here because you're outside of the area, value area. And then you can see it gets support and turns back up. Here you get resistance and you turn back down. So this is where I shorted. right here. Okay. Now, we do have volume divergence on this trade, but it's not drastic. Okay, so what I mean by that, we have it in the tick chart right here. Okay, which I have these signals built out in Bloodhound for the volume divergence because it is one of the harder things to learn. I don't think it's that hard, but some people find it difficult. It's just something I kind of see naturally now, but and you will too after you learn the methods. It just takes a little while to learn them is all. So volume divergence essentially is when we're coming up to this high, we want to see, well, not necessarily want to see, but if we do see very high volume on this bar, which we do, it's not huge, but excuse me, it's 176%. Okay, and this is why I'm saying that this isn't a very drastic volume divergence. Okay, when we see very high volume at a high or a low, and then we get a reaction from that area as we do here, and then we go back up. When we go back up and take out that swing high, we would like to see less volume at the swing high, at the second swing high, than we saw at the first. Okay, and the fact is here we have two volume indicators on the chart. All right, the skinny bar is the relative volume. That's looking at true volume as the input. Then behind that we have the wide bar, the fat bar. That's looking at volume per range as the input. All right, so we're not really looking at the volume per range when we're looking at volume divergence. And you can see that the true volume, the relative volume, is at this level right here. You can see the top of that yellow bar, which means it's a churn bar, is here at about 105%. So we do have volume divergence there. It's not picked up in the Bloodhound template because this is not quite as high as usual as I'm looking for. I'm really looking for an extreme spike in the relative volume, which would be marked by a diamond like we see right here, this diamond right here. So this is volume divergence right here, but look, you see, it doesn't quite take out this low. That's the problem. That's why that signal isn't picked up. So when I build out that volume divergence signal, I'm going to build out the volume divergence signal in the actual indicator itself. So that's going to be included as an update for anyone that owns the Bloodhound volume divergence templates. When I do that, I'm going to make an allowance for this exact case right here, where we have the spike in the relative volume, the extreme spike, and then it retraces and it makes another attempt down, but it doesn't quite take out the low. All right, I would still call that a volume divergence signal because we're attempting another move lower, but it's on less selling pressure. So here we have incredibly high selling pressure. We pull back, we come down, we test this area again. This is Wyckoff's analysis. This is typical Wyckoff type stuff. All right, we put in a very high volume, swing low, we come back, we come down to test that area. We want to test that area on less volume, showing that there's less interest in selling much beyond that point. So we do that, we have a successful test. We know that there's buying pressure coming in on that bar because where? Because why? Because it's closing up off of its lows. We don't need the volume ladder to tell us that. We know that there's buying pressure coming in on that bar because it's closing off of its lows. It's closing up near the midpoint of the bar, so that's obvious buying coming in there, right? Just like you have on this bar. It's obvious buying coming in on that bar, and it's a churn bar. And then it works back up. And then you've got obvious selling coming in on that bar. Why? Because it's closing near the midpoint of the bar. And it's a huge amount of volume. So there's obvious selling pressure coming in right there. And what does it do? It comes back down. And then what? You've got obvious selling, buying pressure coming in right there. And then it works back up. Obvious selling pressure coming in right there. On a weak climax, and it comes back down. So that's just the way that it works. Now, like I said, we do have the volume divergence, but the most important thing in this signal, we're overthrowing the area on the 20-minute. We're hitting the area perfectly on the 240-minute and on the hourly. And then here, we're up above the second standard deviation of the VWAP, so we're very overbought on the day. Very overbought. We now have momentum divergence, which is another confirming factor. But the most important confirmation here for me, and for us as traders in this room, is this bar right here. This is called an extreme churn bar. We don't see these very often. We see maybe one or two a day. And you'll see it was also my exit, which was a perfect little exit. I should have gotten back in. I told people to do so. A lot of other people did, but I just kind of quit for the day after this one perfect trade here. So on that bar, you see how it's much narrower range than the previous bars? See, all of these bars are pretty wide bars, right? Very wide-ranging bars. That little bar right there is almost like a doji, isn't it? Kind of a narrow range bar, but still a relatively fair amount of volume. It's above average. It's right at 105%. You can barely see that because it's yellow, but it's right at about 108%. So still a lot of volume, but much less range. So that's very high volume per range. What does that mean? What does that mean? High volume per range. That means that more volume is now necessary to carry that market every tick further in price than has previously been necessary to move the market every tick. So it's now, the market is now requiring more contracts to move every tick further. What does that mean? That means that you're running into an area of resistance at a high. If you're at a swing low, then you're running into an area of support. So there's obvious resistance and obvious supply coming into the market right here. So I see that, boom, I pull the trigger. It comes right down, it breaks the swing low. I take one off, which is half of my position. I should have been short 15 here, but only shorted 2, just, I don't know, out of, I guess because, I have the free trial for the week and I'm kind of nervous. I messed up the previous day and I'm a little skittish. So I only short 2, unfortunately. And then it comes down, it breaks that low, I take one off. And then it comes down here, and what do we have here? Boom, we've got another extreme churn bar, don't we? And what else do we have? We have volume divergence here. You see we got the spike in volume here. This isn't the cleanest volume divergence signal that you'll see. It's not very clean at all. Typically what I like to see is a pullback. I want to see it pull back and then come down and test that low. But here we've got a very wide-ranging bar, a very obvious selling climax, slight pullback, and then it comes down, and what do we see? We see major support coming into the market there. And then it turns back up, and it turns back up on a very obvious ABC correction. And look at where it ends, guys. What were we talking about 20 minutes ago? We were talking about how to time the end of a correction, the end of a move. Not necessarily a correction, but any move. Here we've got a perfect ABC, and where does it end at? It ends right where the median line intersects the auto line, the channel line. And then it comes up here and it makes a double top, which is also an area on the tick chart, which we'll show you in a minute. And then it rolls back down. So that would have been your re-entry, as I was telling everyone. Then it came down another 150 ticks, or another 120 ticks. So that was our main entry for the day. It's just a beautiful, beautiful trade, perfect area, everything's coming together, and just a beautiful trade. So Riker's asking for more examples. We're right at an hour now. So we're going to finish up with the exit here and then call it a day. You can see the videos of the trading room. They'll be up on the website here shortly. And the rest of them will be put up tomorrow. You can watch those over the weekend. And then we'll have one more webinar on Sunday evening. Okay, so when we're fine-tuning this, we've got the 3-minute and the 1508, but we also use the 1-minute and the 233, which is right here. Okay, so everything is kind of coming together at that high, obviously, which is where I shorted right here. And then we have the obvious signal on this reversal bar, which is the point at which I should have sold market another 10 contracts right there, as we have the reversal bar on increased volume. It's showing as being a climax, which is why I'm reprogramming this. This is the start of the new move down. So you've got a very large number of contracts per tick relative to the previous bars. And it's the start of a new move on that reversal bar with bearish divergence. You get the kickoff and very high volume to start that new move down. And right at this high, which is where I start to have my finger on the trigger, ready to sell short, you've got very high volume per second, and you'll typically see that at major turning points throughout the day, which is essentially showing you that you've got a ton of market orders coming in, and typically stops are being run, where you just have a lot of kind of excitement, typically climactic action. Anytime you're breaking a previous swing high or low, there's invariably going to be somebody's stops that are getting run, and either getting run or somebody's building a long position or whatever, breakout traders. So you'll typically get these high volume per second bars coming in on the tick charts, showing you that a lot of market orders are changing hands there. A lot of contracts are changing hands. You got a lot of market orders firing off, and typically they're running stops. I see that. I've got my finger on the trigger. It starts to turn down a little bit. I put in a limit order. I get filled. And then right here, I'm thinking about getting in more. I have a couple of more contracts to sell just above it, but it never does pull back up higher to fill me on those other contracts. So I just end up with 2. And then we come down. And I think we hit, we just barely pulled overthrew the median line and the auto channel line. So when I see that extreme spike in volume right here to end this down move, and then it turns back up really fast and strong, I went ahead and got out of one of my contracts. And then it pulls right back up, and this is where I should have re-entered the trade, which is from the upper median line. And on that reversal bar, just before that reversal bar, we have again another extreme spike in the volume, and then the reversal followed by a churn bar, which is very high volume per second. You have a lot of market orders coming in right here as they kick off the new move down. And then as they take it down, we're looking for the next target to get out of this trade. And we draw in our areas here. I was looking at this lower median line to get out, but I said, no, I want to take out the previous low. So I was waiting on taking out that major low, but then I saw the lower median line and I wanted to play it safe, and here on the 20-minute we came down and we tagged this lower median line. So we've just had the auto line respected. So I'm thinking, well, it didn't quite make it to the median line. So maybe, you know, I don't know what I was thinking, but I got out when it came down and it tagged the median line right here. Sorry, right here. I went ahead and got out right there because it didn't quite make it up to the upper median line. So I was thinking, well, maybe it won't quite make it to the lower, but anyway, it did. And that was actually right on the 1 minute. Let me just show you here. That was actually right here. Okay, so we have volume divergence there, as you can see, marked by the bars, the green bars here. So we have the volume divergence. Okay, we have two churn bars back to back, and then a quick, fast little push down, which was right here. And then here we have two little weak churn bars back to back. When I saw those two, I said, okay, I'm just going to get out because we have volume divergence here as well on the fast tick chart after that extreme spike. So the big boys are starting to unload their positions right here. And I say, okay, well, if we have volume divergence there at that next low, then I'll go ahead and get out. And that's what we had. So I went ahead and got out, and I closed the position, and that was it. Now, on the next move up, all right, let's just delete these median lines so it's a little bit cleaner chart. On the next move up, which was, again, just a beautiful ABC corrected pattern. And you can see here we have the ABCD projection lines. With the fibs built into this tool, we have several different market geometry buttons here. I don't want to go into the details of that. There's a separate video on that. But here, we pull back up and we tag that downtrend line here. Here, first of all, we tag perfectly right where the median line intersects the auto line. So that's the perfect spot in both time and price. You've got the 100% extension, the fib. You see that green line? That's the fib, the 100% extension. Perfectly coming together right there for a beautiful symmetrical ABC pattern. And then it pulls back, goes back up, makes a double top, and it finds resistance on that downtrend line and then rolls over. And a few people in the room took that short. I don't remember how far they wrote it out, but you know, we talked about it for 10 or 15 minutes while it was happening, and unfortunately I just didn't take it because I'd already made my money for the day, so I was done and had a nice week, except for the previous day, which I recovered from in the evening. That's all in the video from today, from this morning. And then it continued down for about another 120 ticks. And how does it end? Well, it ends on volume divergence with what? An extreme churn bar right at the low. You got the selling climax. You've got the extreme churn bar right here coming in, showing you that demand is starting to come in. You got the extreme spike in the relative volume. You're breaking yesterday's low. All right, remember, we want to see some strength after such a strong down move like this. We want to see some strength come in. Then we want to take out that low and preferably see less volume at the low, and then see some sort of demand coming in, which we see here closing up off the lows on an extreme churn bar on volume divergence. And that's it. And then it just turns right back up. So, pretty good stuff. Pretty good stuff. So, all in all, a decent week. I think I only ended up making about $5,000 this week, but not nearly what I would usually make. Let's see. Yeah, 51.70. So this is not right because I took 15 contracts on that loss which was one of the few times I actually traded 15 contracts this week, and I took each of those individually. So it's looking at 15 trades. It's looking at one trade as being 15 trades, and it's counting all 15 of those as losers. So these numbers are skewed. At any rate, this is about the worst week that I've had, but all of my weeks were profitable. I mean, you know, every single week that I've had since March has been profitable. So I doubt that we'll ever have a losing week. Actually, I don't doubt it. It will happen. It will happen. But this is where I had back surgery here. So one thing is, we'll never have a losing month. That would be impossible with this kind of trading. We may have a losing week occasionally, but never a losing month. Okay, and of course we will have the losing days, since we're not taking very many trades per day. On average, I think I'm taking on average about two trades per day, something like that. 1.8 trades per day on average. Some days I may take 4 or 5. One day I may take none, because nothing's setting up. So we're waiting for very high probability trades, especially high reward to risk ratios. So typically we'll look for, anything greater than 5 to 1, and some of those end up being well over 10 to 1, like today's was about 8 to 1, 9 to 1. So, any questions before we call it a day? So this was mainly just a training session. If you want to own the software, there is a sale going on right now, and we'll talk more about that on Sunday. There is the link to the sales page. Okay, I have not been keeping track of the chat room. I imagine Clint has been answering questions, I'm sure. A lot of you other guys have been answering some questions. But anything in particular anyone would like to ask? Riker's asking, how do I watch the webinar recordings of this past week, as I couldn't attend live? That link that you have there, the Master Suite Pro sale, I'll put up all the videos on that web page. Yeah, the recording will be right there on that page. There'll be a list of the recordings. Leon says, I asked before, can you copy the channels to other charts? Yeah, absolutely. So look, let me show you this, guys. So we have, I don't know why Ninja destroys my workspaces sometimes, but it just does. And it really gets on my nerves. The way that they save XML files is just ridiculous, but we work with what we've got. So what I'm going to do is I'm going to add something called the trend channel copy indicator. And that is right here, trend channel copy. And I'm going to find the chart that I want to copy from. I'm going to copy from the 1508 tick chart onto the 233. No, there's no, the free trial was this week, Jorge. So you would get a free month in the trading room if you bought the software. But there's no free trial on the software, there's no free trial in the trading room unless you buy the software. Then you get a free month in the room, and then the room is $199 after that. I don't do free trials. I've had a lot of guys try to steal my stuff, and I don't mess with free trials. It's mostly a waste of time anyhow. So if you're serious about it, this is about as good as it gets. So when I draw a channel on this chart, you see it's drawn automatically onto that other chart. So what I'm doing is I'm drawing all of my higher time frame market geometry on the 240 minute and the hourly, and I'm going to draw that on the 20 minute, so that I basically only have to look at the 240 minute and the hourly typically once or twice a day. and then all the market geometry is updated automatically on my 20-minute, and it just makes using this stuff a lot easier. So pretty cool stuff. Yeah, the software, I think, is priced very, very inexpensively, as most people would have paid for it 2 or 3 times over this week, just this week alone. So there are a few different pricing points. It depends on whether you have Bloodhound or not, and if you don't own Bloodhound, you don't want to own Bloodhound, you can get just the indicators only for $18.29. I think that's ridiculously low compared to what other people are selling it for, but you know, you could have easily doubled that this week. But you don't get a free trial in the room if you just own the indicators. You would have to own the volume divergence Bloodhound templates to get 1 month free in the trading room. Okay, but we'll go over all of this on Sunday. I don't want to turn this into a sales webinar. This was mainly for teaching the members a little bit more detail about the trade that we took today, so that everybody understands what we're doing. Just making sure we're already on the same page. And if some of you own a few of my other indicators already, then there are a couple of other options here. If you already own some of my stuff, this would not be something that you would try to take part in if you don't already own any of my software. See, already own. So these are the 3 choices with Bloodhound, if you already own Bloodhound, with the volume divergence templates. If you don't want Bloodhound or the volume divergence, then you can buy just the indicators, and you simply just wouldn't get the first month free, which is $199 per month for now, which would be locked in. You would be locked in at $199 per month for life, but it's probably going to go up to, I don't know, $400 or $500 a month, depending on how well we do in the room. If we're doing really, really well, then any newcomers that would want to come in would have to pay for it. So I think it's incredibly inexpensive and affordable for right now. This is probably going to be tripling when I move everything to Ninja 8. And then after I sell enough licenses and there are enough people in the room, I'm taking it off the market. And then I'll probably end up getting 5 to 10 people from the room that learn how to use the stuff well, and then start a proprietary trading firm, which is my ultimate goal, using these methods. Okay, so that's it. Are there any other last minute questions? Beautiful trade today. Just beautiful. Anyway, how many hours do we trade per day? Riker is asking 3 hours usually. 7:30 to about 10:30, sometimes 11:30. 3 to 4 hours a day. Why aren't NinjaTrader 7 indicators compatible with Ninja 8? Because they've changed a lot of stuff in Ninja 8. So everything has to be rewritten. All the drawing objects have to be rewritten. Just a lot of the code, the way that we do things in the code, has to be rewritten. And it's a pretty lengthy process. So it's not something that happens overnight. It takes a few months. It takes a lot of money, man. A lot of money. Spent almost $250,000 on programming the past couple of years. So, any last minute questions? That's the link to the sales page. Again, if you have any last minute questions, just post it in HipChat or the chat window in Zoom. Otherwise, we are going to end it there. The timeline for Ninja 8, probably the end of March. Yeah, the MSI installer is not ready yet. Stefan. It'll probably be tonight or tomorrow morning. He hasn't finished making it yet. I'm waiting on the guy to finish it. So as soon as he sends it, I'll put it up on the site. If he doesn't finish it tonight, then he should most definitely finish it tomorrow morning. Otherwise, I'll just put the files up on the site and you guys can just, move them into the workspaces folder and the I'll probably just do that tonight anyway. I'll put up the files tonight and then no. Okay. Yeah, that'll be a support headache. As if we don't have enough support tickets already. So the installer will be ready tomorrow. Yeah, there's lots of stuff. I mean, you have the software on there already. You can just import it like you would a standard indicator. All right. So we'll end it there. Francis is asking, Dan, how often can big trades like today's be expected? A couple times a week. Yeah, a couple times a week. We get a lot of 40, 50 tick winners. It also depends on volatility, but crude has not had a problem, no problem with volatility for like a year. So yeah, Al. Second installation, yep. 2 licenses. And hopefully I don't see when I check the licensing that your laptop is in Asia Minor when you're logging in from New York. Yeah, I might actually. Yeah, you would have to update your Bloodhound. Yeah, you would. 5 times 2, so that's $100 to update. I think something like that, like $90 to update Bloodhound, something like that. But yeah, I'm making it with the most current version. Alright, you guys, we're going to end it there. I'm going to stop the recording now. Everybody have a great weekend. And we'll see you on Sunday if you want to join in on the sales webinar. If you already own the software, we're not going to be covering anything new. I'm just going to kind of wrap everything up and do a kind of recap. Probably a little bit similar to what we did today, except go into more details about the different indicators. It's hard to get through an explanation of the software in an hour. I don't know. People can't really handle going over all this stuff in 1 hour. It's kind of mind-numbing. So I may just do kind of a quick overview and just tell everybody, what's involved, what you get. It'll be the same time as today, 4:30 on Sunday, 4:30 Chicago time. All right, thanks, Craig. Stefan, the video, look on the... Have you been on the members area? It's the first couple of videos on the Floating Toolbar Pro and the Divergences Pro. It says inputting the license key. So it goes right here. You Control C to copy and then Control V. You can't right click, so you have to use Control plus V as in Victor to paste into here. Then you click anywhere and it validates the license. Well, that's only for the Divergences Pro 2 and the floating toolbar. And then you send me your license, your custom machine ID for the other indicators. You have issues getting into the members area? All right, I'm going to end the recording there, and then I'll leave it up for a few minutes. So I'm going to stop the recording now.